Sound check, 1, 2, 3. We're going to start here in a few seconds. If you can do me a favor, please type in a chat box that the sound is good, and we're going to start in a moment. Okay, we're starting in a 4, 3, 2, 1. So thank you again, Joe. Thank you, everybody who's attending here. I want to make sure that we read this disclaimer. It's very important to know that we are not financial advisors. My name is Josip Kosik. Today is February 8th. Market is kind of consolidating after the big move down. If you need to contact me, feel free to do so here at tradewithufos.com. And I would like to share with you the agenda that I have prepared for today. So these disclaimers are being acknowledged. All the trades are for educational purposes only. And here's the agenda for this morning. So we're going to start with the big picture. We're going to look at the S&P 500. That should take about 10 minutes. Then I'm going to place the live paper trade, and I'll tell you why I'm considering doing the iron condor in a moment. And then I'm going to take some time to explain it. And if there's a time to do one more iron condor, I'll do one more iron condor. But in that case, I may do iron condor, and I'm going to put here in parentheses maybe on a big one on the SPX. And then I'll kind of maybe compare the side by side. The one is a 10 times greater than another. So of course, SPY is the smaller of the two, and SPX is bigger. So if the SPY is sitting at 400 and something, then SPX would be at 4,000 something. So anyway, so are we good with the agenda? Hi, Mark. Good to see you. Hi, Joe. So we're gonna start first by looking at the big picture. And big picture is something really that we should be aware of the daily basis. And reason why I'm saying that we should be aware of a daily basis, because if you're really committed to trading the market, we should be trading similar products day in and day out. And in that case, what would happen, we would actually be able to close our eyes and know exactly what has happened with the market, because we are so in tune with it. So I will look at the SPY in a second, but what I'm going to do now, I'm going to just start a little bit with the VIX, just for a moment to show you how much the VIX has climbed up to the upside. So when you're looking here, starting from the top to the bottom, this black line represents the 9-day exponential moving average, and we are now way above that exponential moving average. On auto climate, it shows in the terms of the standard deviation that we are out of the 3 standard deviation, we are currently on a 5th one. So that means there's a high chance, statistically speaking, that there should be on a VIX a pullback. And in a moment, I'm going to talk about what is that going to be. Then on S&P, it's going to be exactly inverse. It's going to be actually a rally, because according to statistics, in the past, for about the 3 days, the S&P 500, the VIX that tracks the S&P 500 has been up, and we are currently, if you observe over here, we are currently already 5 of these sessions. So we're kind of overextended from the 9-day exponential moving average. So moving on here on this chart, I'm gonna change the VIX not on a 55-minute calibration but on a daily. And the reason why I'm doing this, so I can point out to you the resistance that is coming up. So we have a resistance back in February 24th when we reached that level of the high 37 and we pulled back. And then we also had a peak in January 24th. So that's kind of like interesting that both of the days are 24th and the 24th. And what is interesting here that we are kind of approaching that level. And when VIX is approaching that level, that's mean that the SPY is probably ready to reverse. So having completed my analysis of the SPY, I just want to point out to you that the VIX is showing the real fear in the stock market. But because for the last several sessions, we are now ready to most likely to reverse. Okay, so starting with the SPY, I must say the SPY has a confirmed downtrend because we are below the moving average over here that looks at the 9-day exponential moving average. So we are definitely below that line, and that's for the last two sessions. And as you can see over here, for the last two sessions, we have had the red dots, and currently we are on a second one. And according to the statistics, the standard deviation means 68% of the time, which means in this particular situation for the last 2 days, we've been down, and according to standard deviation, most likely there's a high chance that there might be some kind of bounce. However, I want to look at the puts here that are gray line and explain to you that this blue line that represents the calls, it's below the gray line that represents the puts. So there's obviously more put activity than what is a call activity, and without any doubt, there's a more trading of the puts than a calls, which means there's still a lot of fear. And again, as you can see, this would be the low of that February 24th, and we're now approaching it. However, when you look at right here, we can actually make an argument that when you're connecting these two dots between February 24th and today's price action, we are actually having a low that is slightly higher. Now, one of the things that I want to mention to you is that after such a big down day, it's normal for the market to start balancing and to start going sideways, because two trending days back to back are very kind of unusual, so the odds are that today is gonna not be another trending day lower, although we are currently a little bit lower, but the day is not yet over. We are into this session only about the hour and 38 minutes. There's a high chance that there is going to be some sideways movement up and down. And I would like to now move on away from looking at daily and look at the different calibration for different time frames. So let's say like for the 55-minute, I'm seeing that there's a lot of red UFOs, meaning unfilled orders, right at this level, and this would be a good place to place the bear call spread somewhere in that area. So I'm looking at the number 424. So this 424 number is something that I should be aware of, because if I'm later on building the iron condor, which is composed of both the calls side and the put side, I would need to know that the selling to open 425 call would be a good place to start the bear call. Now, I would like to also place a bull put spread, but for that sake, I would need to go back to the daily in order to project what is called the top speed bump. So I'm clicking now on the top speed bump, and I'm selecting the extreme, which is this February 24th, February 24th. And when I clicked on it, it gets projected. And I'm going to just squeeze the chart over here so you would be able to see the green unfilled orders, which are the area that most likely the institutions have a ready to buy orders. And again, I'm going to read those numbers there at 398 and 395. I'm going to bring up my Word document, and on that Word document, I'm going to type in the lower. It's a 395, and that's going to be for a put, and that's going to be sell to open. So what I'm going to do next is I'm going to utilize the platform with these targets. So if I now simply go back over here and place my mouse at the 395 area, which is exactly area that I was predicting that I should have my bull put spread, 395, and I single right click, I will go send to, and now it says a strategy builder target 395. What is going to happen here, I'm going to get the suggestions for placing the trade. Now, of course, I would need to hide the risk graph, and I would need to read through each one of these to see what are the choices that are being given to me. So as you can see over here, I have several choices here of the different strategies, and one of the strategies that I'm looking for, it's not a bear strategy, but it's actually a bull strategy. So I'm looking for a bull put, and I'm gonna now observe over here what is the time that is being suggested in terms of when the expiration should be selected. So I'm gonna circle this so it's a little bit more obvious that it's April 10th. April 10th is going to be approximately my target day that I will gonna utilize. So what I'm doing next is I'm bringing in the Thinkorswim platform. I'm gonna be changing this to the SPY, and I'm gonna look at the cycles that are on the April 10th. So obviously I see that I have April 1st, April 4th, April 6th, and April 8th, right? So if the liquidity is not good on these, I'm going to start changing my mind and not looking at it, right? But as of now, there's only few things that I want to observing. In a layout, I'm going to just ask for the volume and open interest. So for the volume and open interest, I'm opening up the April 8th. And as a reminder, the strike price that I'm building right now is centered around 395 put. So if I don't see enough liquidity at the 395 put for that particular cycle, I'm going to go to different cycle. But what was really helpful for me that I know expiration that I need to do. So I would need to add more strike prices. I'm going to just simply type in some big number like a 48, right? So when I type in 48, this is a call side that currently I'm not going to look at. And the reason why I'm not going to be looking at the call side right now, because I'm building the put side. So here is a put side, and this is the area that I'm looking for. And specifically, I'm looking at the 395 put, and I'm looking what is the activity. So I have 131 contracts traded this morning, and I have an open interest of the 389 on this particular cycle. If I would just alter this just a little bit by going to the, let's say, April 11th, and looking at the same strike price of the 395, I want to just compare it, and I want you to observe that the numbers are significantly dropping on the put side on a 395. For that volume, we have a not 3 digits, but we have a 2 digits. Therefore, the top platform was dead on when it said to me, you should do this. Now, could I also pick the option that is not April 8th, but it expires earlier, April 6th? So let's now make all things fair and square and look at it. What is the activity of the 395 in terms of both volume and open interest? So what I'm looking right now, it's again the puts, again on the 395, and I'm seeing the open interest is looking good, but the volume traded today is not that good. So one more thing I'm going to change here, and the reason why I'm changing here from the April 6th to the April 4th is to have enough pool of evidence to feel comfortable whether or not I have selected the correct expiry. So when you're looking here at the 395, same logic, 395 has a volume of only 14, open interest of 251. The top platform was dead on when it said to me, you should pick the April 10th, but instead of picking the April 10th, the current situation point out to me that the April 8th is having so far the triple digits in terms of the activity on a 395. So I'm going to be doing the 395, and I want to ask a question. I'm going to take a moment if you guys can type in a chat box, what should be my protective unit? Because every time when I sell something, which I'm selling 395, which is definitely out of the money, and we are currently at the 418, there's a lot of room for me. I'm then obliged to buy at 395 S&P if it drops. But what about if it drops and goes below the 395? Where should I put my protection? At this point, your eyes should be all looking at the biggest possible activity. And that biggest possible activity is this 4-digit number right here. 4-digit number right here. And that is the strike price of the 390. So I hope that is clear, Mark, Joe, JB. If you can type in that it's okay, like that, then I'm going to actually go ahead and proceed. So what I'm going to do now while you guys are typing response is I'm going to bring in again this Word document, and I'm going to, in that Word document, type in that I'm buying to open 390 put. Now I want you to observe, okay, so good feedback, Mark, I really appreciate it, that this trade is going to have invested $500. $500. Now I can do this trade as a one trade, or I can do it as an iron condor. So I'm going to just specify here that the SPY is sitting here around the 418 currently. I'm giving myself more room to the downside than to the upside in terms of the protection, because if I'm selling to open the call side of the 425, that's only about the $7 move to the upside, while over here I'm giving myself quite a bit more room. So for simplicity's sake, what I'm doing right now, I'm actually just about ready to execute this trade. So the way how I'm executing this trade, I'm placing the mouse on the bid of the 395. I single right click, I select where it says the word sell, and then I go on a vertical, and I want to first change the contract size down to 1. And I purposely left this on a 10, so I would teach the traders who are currently attending this session never to rush to get in a trade. Read every single screen of what you are doing. So to make this thing even better, I'm going to jack up the credit from the 22 to actually 25, because I don't want this to get filled. What I actually want to happen here, I want you to see how the things work once when I send this in. So I go confirm, and this is what it's saying. Because this particular spread has been entered as a $1 spread, meaning buying the 394 and buying the 395. The credit is 25 and the risk is 75. When you add the 70 plus 25, you get 1. But that's not what I want to do. I want to go slowly over this. So I have adjusted the size correctly, but what do I need to do next? Well, I need to do next adjustment of the strike prices to the 390. So now when it's at the 5, I expect to get at least $1. So what I'm doing right now, this still remembers the 25 cents from the $1 spread. But if I unlock it here, it's going to instantly remember that currently it's sitting at 109. I don't want to get filled right away. I'm going to jack it up to 110, which is about the cents or so higher than the mid price, because I want to work this order in. So now when I go here and confirm it, I want to point out to you over here, if you can see it, that I have the spread that is $5 wide. So this $5 wide means I'm asking $110, and when you subtract the $110, then you actually end up getting maximum loss of $390. So $390 is the most that I could lose on this particular trade if it goes against me, because I have already received 110. Now, let's see if I could actually receive this. There's no guarantee that I could, but we'll try to send it in. So I'm sending it in, and you would notice here it says you have a position, but you did not hear ding. Now, on my platform, when I get filled, you're supposed to hear the ding. And right now, it shows that I do have a position open, and I have gotten what is called price improvement. I was willing to take $1.10, and I have gotten $1.28. That means the math has completely changed. In this particular case, if I duplicate the order, but I'm not going to confirm it, I'm now risking only $372 to make the profit of the 128. $372 to make the profit of the 98. So let's now spell this out, okay? So this side is a bull put. And I'm going to spell it out. This is a OTM, out of the money, bull put spread that I have placed, which is risking $500, right? But in reality, we got the credit of $1.28. That means the risk is $379. So $1.28 is a risk. It's a credit, and then the maximum loss $372. Okay, let me show this one more time on the platform here so it's not confusing, because it's really important for me to explain every single aspect of this trade. So under the monitor tab, there's a one position open currently, and that is one that ties up the buying power effect of the $500. So as of now, it shows I already got the $15 because that's the price improvement. If I go over here when it says account statement and I go cash, okay, we had the previously trade on XLE. It hit the target, it closed up, we made $63 because this account started originally with $26,000. Now I have received the credit of the 128 and account has jumped up. So, Mark, you got filled at a better price, $1.41. That's wonderful. That's wonderful. Be aware of it that I'm using this platform, and I want to now go to the other end of this thing, and this is the top, and I'm going to pull up the option chain. And when I pull up the option chain, I just want to revisit one more time these UFOs right here that we were looking that we're gonna place our top part of the bear call, and I'm gonna call it the bear call just in red, so it kind of stands out and it's easier, at 425 at the first glance. Now I'm seeing right here 427, 433, 37. I think I'm gonna alter the prices a little bit higher, which would make it safer and it would be above it. So I can do 234 or I can do 235 for my bear call spread. That's just kind of a suggestion of what I could do rather than using the 225. So most likely it's going to be 234, but let's prove why it should be 234. So what I'm doing right now, I'm opening the chain. It says a SPY here. I have a different expirations, but I know the one expiration that I need. It's April 8th, which means I can eliminate these other ones that are being opened. I can go over here at the different strike prices and I can select exactly what I really want, which is 435. And most likely I'm going to do the higher leg, 435. That would be 440. So these are going to be highlighted so I can actually see better what is going on. So the strike price that I'm actually addressing is a 430. So let me make this again a little bit more obvious. What I'm going to do here, I'm going to change color into red. So when I change a color here into red, it's going to be easier to kind of track what I'm doing. Oops, well, 1 second here. 1 second here, just one moment. Okay, so I'm going to make it red. And I'm going here to 435. Volume, only 52 contracts. Open interest, triple digits. 440, that's my protection, that's my hedge, because otherwise selling of that call would make it into naked call. I cannot have a naked call, but if I go ahead and buy this 440, then I have a long call, and against that long call I have a right to sell something, and I'm selling the lower strike price, which is 435. It has a triple digit activity right here, and it has a triple digit activity right here. It's looking good, so I will take these strike prices. I will take the strike prices the way they are. One more time, logic behind it. Why did I pick the 435? I picked the 435 because it's above this number. This number right here is the higher of the two numbers. So we have a 427, that's the lower of these two numbers, and then we have a 433. I have rounded up to 435 to give myself even a little bit more breathing room to the upside, because as you recall, I actually have a current price at the 418 and it's dancing. So picking the 435, at least to have some protection to the upside. So by the way, this is a bear call spread. This is a bear call spread, and bear call spread has two legs. It has a leg that is a call. 440 is a call, and also it has a leg that is sold, and that sold one is the commanding unit, while this one is just auxiliary unit. This is nothing else but the hedge. This is my hedge, and this is my commanding unit. This unit is the one that brings me more money rather than less money. So having said that, now it's 8:29. I'm gonna go into Thinkorswim. I'm gonna place this trade on, and I'm gonna now go to the call side. So now I'm right here on the call side, and one more time, same concept. Please do not look the puts. They are irrelevant right now, and the reason why they are irrelevant, because we're no longer dealing with the puts, we are dealing with the calls. Specifically, we're dealing with the call 435 and 440. So how do we execute? We execute similar way what we did earlier. We're gonna put the mouse at the bid, because in reality we're selling. Single right click, sell, go to the vertical, and expect they're gonna give me a wrong strike price. Default setting is gonna be $1 wide. So when I click right here, I want you to notice what is it that the platform instantly gave me. Well, instantly gave me the nearest one, which is higher than a 435. So 435 is the one that I'm selling, and 436 by default setting that they fill it up is the one I'm buying. So you know that we need to change this to the higher number. And in this case, the higher number is 440. Another thing that we need to do, just sip the water here for a moment. We need to make sure that we adjust this to one contract, and because I don't want this to instantly get filled, I want to have this thing as a working order. I'm going to jack it up to unrealistic price of the 180. And the mark, if you got filled better than that better than I, feel free to type it in, because I want to make sure that you follow that trading needs to be enjoyable and not like something that makes you sweat and upset and angry. If you're in that kind of mindset, then maybe you should take a trading day off rather than forcing yourself to trade. So this assumes right now that this is an independent trade from the bull put spread, and it's considering that you're still risking $500. And the reason why it considers that you're risking the $500, because it doesn't recognize that in a portfolio there's already another trade that is $5 wide, right? So it assumes as this is a new trade, it ties up another $500. However, the good news is that they're giving me $180. And because they are giving me $180, do I really need the $500? No, the broker actually is gonna hold 320 of my money, because 180 is actually their money. That's the money that they are giving me as a maximum profit. So be aware of it. Once when I send this in, most likely it's not going to get filled. It would be a real miracle if I got filled. So I'm sending in. Now notice the difference. Here when I'm filled, it says a position. Now I can even change the volume just to read to me the word position. And that's helpful because, sometimes you don't know how many contracts you have. In this case, while I'm teaching, I just keep it simple on the 1 and 1. So now when I go over here, you will see the column position has nothing, but the orders are saying sell and a buy. And once when the cell gets filled, it becomes a red rectangle with the word POS that stands for a position, and a buy order becomes a green with POS saying a position. So I would obviously need to now work this down. But before I start working this thing down, rather than going account statement, which still shows I didn't get filled, I did not get filled, I'm going to go into activity and point out to you that now the account has recognized that I already have on the same cycle, position. So once when I get filled, the buying power effect is still going to stay at the 500. So I'm going in a working order. It says, oh, you're greedy. You want a 180 when in reality the market is trading at a 170. So I would need to tweak this thing down. So how do I tweak it down? Single right click, counts and out replace, plus sign brings it up, minus sign brings it down. I'm going to go down to 75. 175, see if I'm going to get filled. So it canceled. And I want to make sure that you're kind of following the logic over. If I open up the time, so now it's 8:34. I have had that order open at the one that I canceled at 8:34. When did I enter it? Okay, I didn't check when I entered it, but it must have been a couple minutes before. So what I'm trying to say, if they don't fill me, and there's a 7 different option exchanges looking at this, after about 2 minutes, what you can do, you can drop it down. And how do you drop it down? First, you don't confuse yourself. You hide these things. You single right click. You go cancel and replace, and then you start walking down in some kind of logical increments. Let's go 173 because that will pay for the commission. 173, send it in. It canceled. It canceled. So let's see over here. Okay, so I didn't wait 2 minutes because the other one was at 8:34. I usually wait 2 minutes, But anyway, I'm teaching. I don't want to be wasting time. So they're not giving me at 173. After 2 minutes, cancel and replace. Go down to what they're quoting here. And what they're quoting here is actually what? 171. So I'm going to confirm. I'm going to send it in. See if I'm going to get dinged. Okay, so now the market is going down. It just went from 418 to lower. So probably I'm not going to be able to get it at that particular strike price. So let's walk it down again. Let's walk it down again. Cancel, replace. Now it says a 169. Let's see if they're going to fill me at 170. You do not ever send a market order. Market order is for the stops, not for entry. When it's entry, you have a luxury of time. Time is on your side. Well, actually, time is now not on my side because this thing is dropping. So I better hurry up here. See, now it says a 67. Let's give them 67. Okay, now it had a little breather to the upside, but it's still going down. Okay, I want to place this trade also on SPX. So I'm going to just hurry up here. I'm going to give them 165 here. Mark, did you get filled? You got 141 on the put side. On the bear call side, you're probably working the orders the way I do here too. I'm usually going 2 cents increments. Yeah, but this thing has dropped virtually like 90 cents ever since I started placing these trades. So definitely market is doing what I said that it's doing. That's fluctuating. Okay, let's make sure I get filled at 160. It's kind of easy. Because what the next step of my lesson is to transfer this information to the SPX. So while I'm patiently waiting to get filled, what I want to do now, I'm going to create this. So this is going to be the SPY side, and this is going to be the SPX side. So in a moment, I'm going to type in the SPX, and I'm going to then have a side-by-side. So if I have the SPY right here in the middle, you probably understand the logic, what I'm doing here. I'm actually placing the bear call spread on the top. And I'm going to have also bear call spread over here. I just don't know what numbers I'm going to have. So I'm going to have a bear calls here too as well. Oops, wrong place. Just 1 second. Need to click it right here. Okay, and it's going to be different numbers, right? It's going to be different numbers. It's going to start something like this, but it's going to be different numbers on a big SPX. And then, of course, same thing with the bull put side. Let me just see if I got filled. So position here is filled. Position here is still not filled. I'm giving them 160, cancel and replace. I have other things that I need to do this morning besides just a SPY. Still not giving it to me. Not filled on a call side. Yeah, neither have I got filled on a call side. So this is a time when you're like trying to trade with somebody who doesn't want to trade with you, and don't push this trade. Like just wait for the trade to kind of do what it needs to do. But for me, for educational purposes, I need to do it. Okay, I got filled. I've canceled the 156. So watch here. when you go over here, how many cancel orders have I done? They were really supposed to read the 2 minutes in between, 2 minutes in between. So I was dropping it from 160 to 158 to 156, and then I got filled. Oh, and then I changed to 156 because it says cancel down to 154. But the point of everything that we do here at Tradactive, Trading with the UFOs, to teach you the process that you can replicate, and the logic of arriving at that particular trade. So I was going down in the 2 cents increment, and then I eventually got filled for a 154. So I got filled at the 154. I'm going to explain this in a moment, but I just don't want to. I just don't want to. So this is already explaining as I'm doing it. This is already explaining as I'm doing it. This trade, which is a bear call spread, it has a same kind of situation. And the reason why I'm saying that it has the same kind of situation because I got filled at the 154. So I got filled at the 154, and over here, what am I risking? Well, that would be 46. Okay. What I want to do next is I'm going to now look at the SPX. I'm going to look at the SPX, and I'm going to point out to you that SPX is currently trading, and let's use Thinkorswim here. So SPY is now at 417, knock down the Y into X. That's the number 4177. And don't worry about the cents because they are kind of I don't want to say irrelevant, they're relevant, when you're trading. But for what I want to teach you here, is just follow the logic here. So I'm going to put here 4177 or 78, it's keep dancing there. But you see the similarity. You see the similarity. So I need to look at the chart to see where is going to be my UFO unfilled order on a chart. So I'm looking right here, and let's go on a daily is 4342, but we don't have that strike price. We have a 4345. 4345. 4345. So that will be 43. Okay, you see the beginning was right. 45. And then I'm going to pick the higher strike price, which is going to be 4350. And reason why I'm doing this, because I want also this to be invested the same amount of money. Same amount of money. If this is logical, Joe or Mark, why not trade the calls in the update? Yes, we could trade the calls in the update, but in that particular case, implied volatility, Joe, should be lower. And I started with the VIX presentation, Joe, and you notice that the VIX is at, I don't want to say all-time high, but pretty high to what it was earlier. So in that case, it makes more sense to do the trades that involve selling of the implied volatility because we are anticipating going down. Okay, let's see. I have nice theory here that I should do the spread that involves 434.45 and 430.50, but there's a couple of questions, unknowns. Okay, these are what I like to call known unknowns. And I know for a SPY that I have a April 8th expiry. Do I know if I have that also for the SPX? And I also know for the SPY, that's a one known unknown, okay? That the volume in OI, that stands for open interest, were in triple digits. Do I know the answer to this? Oh, Mark, very good. So you got filled at the $1.60, and I'm telling you, Mark, patience pays off. I was kind of rushing this one because, as you see, on my execution, I have gone through it a number of times, and I just couldn't get filled. So I'm looking now for the different cycles. Bingo. I have an April 8. That's good. That's good. So that's a one unknown that I was able to take care of it. So I have taken care of this unknown. We have a April 8 expiry. Okay, I don't need to worry about that. That's good. Okay, but what about the volume? Do I have a volume in the triple digits? Well, I mean, we all know that the SPY has amazing liquidity. We all know that SPY is one of the most liquid. So I would go to the 430, 4345, and I would observe whether or not we have that kind of liquidity. So this time I'm not looking at the puts. This time I'm looking at the calls. I don't even show enough strike prices. So I would probably put something crazy like 78 strike prices to see it. Open interest 12. Volume, nada. Houston, we have problem. This is like that song Hotel California. You can checking anytime. You can check out anytime. You just can't leave. You just can't leave. This might not work out the way I like it. The way I like it. But if it did, if this thing did, it would be risking $500. 4345. 4345. 7 contracts traded. Nada on the volume. Okay, you know what? Let's not push this side. Let's look at the bull put side. So what I'm doing right now, I'm again inserting this into this little area. And by the way, just to share with you, Jose and I have worked hard on tradewithufos.com/my name to prepare this Josip Live session. So this is a session that I did not long ago. I guess it was March 4th. It was a double bullish vertical. The one that I show you that got filled, I exited when it hit the target of the 77.20. The notes that I'm doing, this time I'm going to just cut and paste and put it in after the session. So you should be visiting this page to kind of review what is done. But I don't think I will be able to put the SPX trade on. But let's just work through the SPX trade. Let's just work through the SPX trade. So in this case, if I was about to do the SPX trades, and they don't always translate. You see, this is what I'm trying to point out to you. It would start something with 3,900, but don't forget, everything goes where? To the chart. To the chart. How do we arrive at our conclusion where it is? Well, we squeeze this and we see that we have this area down here with the green unfilled orders as a possible area where the buyers might step in. And then on top of it, we have utilized the tool that Trade Option Planner has, and it's called Tom Speed Map. And the way how you use that is that you pick the pivot point, which is the lowest point of this candle of the February 24, and you just symbol right click and this thing gets projected. So what this would mean that most likely price action would go down to this green unfilled orders. It would find some buyers and then it would turn around and start going higher. So what I'm doing right now, I'm just looking at what are these numbers. So of course you have a higher number, which is closer to this current price. And then you have a lower number, which is where I would like my bull put to be. I really want to just trade the time. I just want to trade volatility. I don't want to trade actually price action. So the lower number, the 3966, would be 3965. So what I'm doing right here, 3965, and I'm going to look at it 3960. So if I can at least place one of these trades on, and then you would recognize, and by the way, these numbers are wrong. These numbers are just cut and paste from the other one, but had I placed the bear call, it would invest the $500. What are these numbers going to be, and whether or not I'm going to get anything, it remains to be seen, because this is a known unknown. This right here is my known unknown. Am I going to be the only one dancing on the dance floor? Am I going to be the only person swimming in that swimming pool? And if that's the case, forget it. I'll just be content with the SPY trade. So the Joe, Mark, or whoever the attendees are, if you can type in whether or not you're following the logic, I would really appreciate it. In theory, I should be able to put the very same identical trade on a bigger product. But as I said, you can't put a truck tire on your personal car. It's just, that's not the way how it works. It's not the way how it works. So I'll see. I'll entertain it. So let's open up the option chain. SPX is filled here. Multiple expirations. I'm selecting April 8 and I'm getting rid of everything else. And then when I go over here to the strike prices, I'm selecting the strike price that is lower than where we are right now. So right now we are at 41.65, and I was considering doing the 3965. 3965. So let's go 3965. 3965. Okay, so I have a 3965 and 3960. Okay, so when I do this, one more time, the logic is very simple. Don't look at call side. It's irrelevant right now. We're looking at the what? Put side. Specifically, what strike prices are we looking? Strike prices that we're looking at, these two, and that's why the coloring has changed. Volume, nada. I'm done. I'm not placing this trade. Open interest is only 34. Yeah, I need the both legs. I need the both legs. And over here, it doesn't even have any. So, as I said, I tested the theory. And a theory is a good theory, but in reality, there's no trade on this one. However, we at least have a what? The trade on SPY. So let me now rebuild the trade on SPY using the top. Okay, so what I'm going to do here, just kind of on a second monitor, have a numbers here and then show you the risk graph and everything. So I'm going to go over here where it says neutral, and it's going to be short iron condor on SPY. And I know those numbers are wrong, but I'm going to be editing it anyway. So over here, I'm going to first start with expiration. We have selected the expiration April 8. When I click on it, I want you to notice instantly, I'm going to change this to green, so it's kind of easier to understand, that you don't need to change one expiration, you just change one and everything changes. Also notice the numbers, right? Every one of these numbers is completely wrong, right? But what is interesting that we are starting first with the put side. So if we are starting first with the put side, I'm going from the price that is bought. So the price that I ended up buying, that was a 390. So I'm going over here. 390 is the one that I bought. Then I sold the higher one, which is a 395. So I'm selecting the 395 here, because this is the one that I bought. Okay, so I'm going to bring in the Thinkorswim platform just for a second, because I want to also get the information on my filled orders. You see, this is still sitting at 500. Had I sent the S&P, it would be same $500 in. Same $500 in. Okay, I'm going to just take a snapshot of this quickly, because I do need these values per leg, what I got filled. And again, Mark, please don't copy my numbers. If you're doing this on your end, I would suggest you just fill in your numbers, because it makes sense that it's your trade, not paper trade in this paper trading account. So what I'm doing right now, I'm looking at 390. I have gotten filled for $6.76 on that leg. But the other leg actually gave me more money. It gave me $8.04. So just in case you're confused, I'm going to bring this thing back in so you would know where I got the numbers from, right? So over here, 390 is 676, 395 is 804. So I'm going to tuck this away. We're almost out of time, so I better hurry up. So I go over here, and I'm now moving on the call side. On the call side, I actually end up selling 440 call. So this 440 call is way up here, and then I have a 435 is my other one, 435. Okay, so one more time as a reminder, what am I doing now? I'm showing you the strike prices 435 being filled at $5.35. That's my commanding unit. That's the juicy one. That's the most economic one. And then this one, I'm returning some of the money from the from a 532 credit I have received. I need to return 378. So I'm returning the 378. So again, I'm switching this to the filled. This is a richer of the two, or the way I like to call it, it's commanding unit. And just like in the military, you have an auxiliary unit. So this 440 is auxiliary unit, and that's the one for a 378. So now the beautiful thing is now when I click OK, it's going to spell out right here what is the total that I got. So the total that I got was a 282. Is that really true? Well, do the math, right? When you add up these two numbers, and let's do this so nobody loses me. $154 plus $128, 286. But how much am I risking? So I'm risking less money. So this iron condor, okay, so this is explanation, okay. I'm sorry I couldn't do the SPX, I mean, we looked at it, it was fair enough, right? But conclusion was that this SPY risk 218, that's a maximum risk, with maximum profit if everything expires worthless up to 282. And I think what is really helpful is if I go ahead and take the snapshot right here. So I'm going to take the snapshot of this short iron condor, showing this right here. Another snapshot just before we end the session here that I think it would be helpful is a visual snapshot of risk graph. So I'm gonna have a visual snap of the risk graph. And how do we do this? Well, you single right click on it, you go where it says here risk graph, you click on it, and all that information that we talked about is done right here. So top gives you everything. Top really gives you everything. So this right here is a math that we have done using calculator, when in reality I didn't have to use a calculator. I could have just gotten right here and taken a snapshot. So this is where it shows all math behind it. So one more time, I'm going slowly through this because later on when this gets posted into this Josip's live session, all the relevant information from this hour is going to be right here, and you can just glance at it and say, after brief analysis, whatever we looked at today, VIX, blah blah blah, we decided to do this, screenshots are in it, and that should be done within maybe when the session is over, within a few minutes. Okay, what else did I say I'm going to put in? The visual. the risk graph, and then I'm going to answer the few questions. Yeah, Mark, you were right when you looked up those particular SPX strike prices. There was nothing there, and as I said, Hotel California, great song, but I don't want to be in that position. I do not want to be in that position. You can check out anytime. You just can't leave. That's not going to happen. That's not going to happen. So what I'm doing right now, just taking this visual and dumping it in, and then I'm done. So last, whatever we have here, a couple of minutes, please type in the comments. Was this helpful for you? Was I too fast, too slow, too much on this platform, not enough on that platform? I would really like to hear from you. I mean, I usually go overview at the end of the session. I said at the beginning when I was starting that my agenda was to look at the big picture, and I looked at not only SPY, I also look at the VIX. I placed the live paper trade iron condor. I was thinking I can do the SPX. There was no volume, no open interest. I would be the only one dancing on the dance floor. That's not really fun. I worked out these trades. I got them filled at a different level than what the market did. And then I went ahead and I calculated what's my outcome here for for this trade, and then I went ahead and I snapshotted everything so it's clear. And if you don't have any question, Joe, thank you for that comment. That's exactly what I was hoping that it's going to do. That it's not going to stress you out. It's going to just put the trade on. And really, the most important thing is that we looked at the thing and we concluded this is the right trade for this environment. So one more time, thank you again. Visit this page um, and um, and get the information about this, and you can copy that, put it in your own Word document, alter maybe these prices later on, but the formula is there, everything is there. So one more time, thank you, and I'll see you next Tuesday. Have a good day. Bye now.